You think Coca-Cola makes money selling you a Coke. The red can out of the cooler. The bottle at the gas station. The fountain cup at the movie theater. Billions of times a day, all over the world. So Coca-Cola must be the company that makes those drinks and hands them to you. Mostly it isn't. The Coca-Cola company barely touches the bottle in your hand. It hardly fills the cans, hardly loads the trucks, hardly stocks the cooler. What it actually sells is something you have never once seen in a store, a syrup. And that syrup, plus a name, is where almost all the money is. Here's the picture in your head: a giant beverage company. Factories the size of towns, pumping out cans around the clock. Fleets of red trucks fanning out to every store on Earth. The Coca-Cola company took in about $47 billion in 2024. So the obvious story writes itself. Make a drink for pennies, sell it for more. Do that billions of times a day. A vending machine the size of the planet, and the drinks really are everywhere. That part is true. Coca-Cola products are sold in essentially every country on Earth, billions of servings a day. So you would naturally assume the company behind the brand is the one filling the cans, driving the trucks, and collecting the price of every single bottle. It is the most famous consumer product in history. Of course Coca-Cola makes it. Of course Coca-Cola sells it. That is the whole idea of a brand. But here is the crack in the story. Most of those cans and bottles are not made by the Coca-Cola company at all. They are made by separate companies called bottlers, and many of them are giant, independent, publicly traded firms in their own right. The bottler near you takes something from Coca-Cola and then does all the heavy lifting. It adds the water. It adds the sweetener. It adds the fizz. It puts the liquid in a can or a bottle, and it drives that finished drink to the store down the road. Coca-Cola, the company, often never touches it. In fact, the company spent years deliberately getting out of the bottling business. By the end of 2017, Coca-Cola had handed off every single company-owned bottling territory in the United States to independent partners. Roughly 60 separate handovers, covering more than 350 distribution centers, over 50 production plants, and more than 5,000 employees. It gave away the factories on purpose. So if Coca-Cola isn't the one bottling and delivering most of your Coke, what on earth is it selling them? Here is where the money really comes from. Coca-Cola's core business is selling concentrate, the syrup base, the formula in liquid form, to its bottlers. The bottlers buy that concentrate, add everything else, and sell the finished drink. The Coca-Cola company even describes its own operations in two halves: concentrate operations and finished product operations. And in 2024, the concentrate side made up about 59% of the company's revenue, the finished product side about 41%. The half you can buy in a store is the smaller half of the business. The half you can never buy, the syrup, is the bigger one. Now look at what that does to the profit. In 2024, Coca-Cola's comparable operating margin was about 30%. Sit with that number. For a product that is, at the end of the day, flavored sugar water, the company keeps roughly 30 cents of operating profit on every dollar of revenue. That is not a soda bottling number. That is not even close. The big bottlers, the companies actually making and delivering the drinks, run on a fraction of it. Coca-Cola Europacific Partners, one of the largest bottlers in the world, reported an operating margin of about 13% in 2024. Coca-Cola Consolidated, the biggest bottler in the United States, came in around 13% as well. So look at the two sides next to each other. The company that owns the formula and sells the syrup, about 30% margin. The companies that buy the syrup, make the drink, and deliver it to your store, about 13%, same red can. Less than half the margin on the heavy end. The Coca-Cola company kept the rich, light end of the business, the syrup, the recipe, the name. And it handed the poor, heavy end, the water, the cans, the trucks, to somebody else. And the gap is even wider if you go one line up the income statement. Before any marketing or overhead, Coca-Cola's gross margin in 2024 was about 61%, 61 cents of gross profit on every dollar of sales. That is the number you would expect from a software company or a luxury brand, not from something you can buy ice cold for a couple of dollars. It is a number that only makes sense once you realize what the company is really selling. It is not selling a heavy, watery, perishable drink. It is selling a small amount of flavored syrup that carries the most valuable name in the cooler. The high margin isn't an accident of good management. It is the whole point of standing one step back from the bottle. So why split the business this way? And why is the syrup end so much better than the bottle end? because the two halves have completely different economics, and one of them is genuinely brutal. Think about what a bottler actually handles. It handles water. A truck of finished soda is mostly the weight of the liquid, plus the glass, the aluminum, and the cardboard around it. It is a low-value product packed into an enormous amount of mass. To move it, you need bottling plants, you need fleets of trucks, you need warehouses, you need an army of people, and at the end of all that effort you earn a thin margin on every can. That is the 13% business. Concentrate is the exact opposite. It is the formula and the brand distilled down into a small light high-value liquid. A barrel of syrup becomes thousands of drinks. It is cheap to produce, cheap to ship, and protected by what is arguably the most famous trademark on the planet. Coca-Cola sells the part that is almost pure margin, and it lets the bottlers carry the part that is almost pure cost. The syrup is light, the water is heavy. Coca-Cola decided very deliberately to be in the light business. And it really was deliberate. Through the 2010s, Coca-Cola had taken a lot of bottling operations onto its own books. Then it turned around and sold most of them back off to independent partners, in a strategy it openly called refranchising. By the end of 2017 it had refranchised 100% of its company-owned bottling territories in the United States. And it kept going overseas. It refranchised bottling operations in the Philippines, in Bangladesh, and in parts of India, a shift the company itself points to when explaining its numbers. In July of 2025, it sold a 40% stake in its India bottler to a local partner. Read that the right way. The company chose to get out of bottling. It wanted less of the heavy, low-margin work, not more. It wanted to be the asset, light owner of a formula and a brand, selling syrup, while partners own the plants and the trucks. That is simply not how a company behaves if making and delivering the drink is where the money is. Now look at the loop that ties it all together. Coca-Cola spends enormous sums on marketing, building the brand, the red, the script logo, the polar bears, the holiday trucks, the feeling. And you might ask, why pour billions into advertising a drink that somebody else bottles and somebody else sells? Because the brand is the entire reason the concentrate is worth anything. A barrel of generic sugar syrup is a commodity. A barrel of Coca-Cola concentrate is not, because billions of people walk into stores and ask for a Coke by name. The more the world demands that specific red can, the more drinks the bottlers have to make, and the more concentrate they have to buy from Coca-Cola at that 30% margin. The advertising does not really sell cans for Coca-Cola. It sells syrup by making absolutely sure the world keeps asking for the brand. Coca-Cola keeps the formula, the trademark, and the marketing. The bottlers keep the costs, and the concentrate flows in between, carrying the profit. There is one more piece, and it is the cleverest part. Because the bottlers are mostly separate companies, all that capital, heavy, low-margin work sits on their balance sheets, not Coca-Cola's. The factories, the fleets, the debt to build them, the thin margins to run them, those belong to the partners. Coca-Cola's own books stay light, clean, and high margin. When commodity costs spike, when fuel gets expensive, when a plant needs rebuilding, that pain lands hardest on the bottler. The Coca-Cola company sits one step up the chain, selling the same syrup, collecting the same rich margin, mostly insulated from the grind below it. That is the real genius of the two-tier system. It is not just that Coca-Cola earns more. It is that someone else carries the risk. And you can watch that play out in the company's own results. In 2024, Cola's operating income was about $10 billion, and its reported operating margin actually fell from roughly 25% the year before to about 21%. Why? The company itself points to higher commodity costs, heavier spending, currency swings, and, notably, the impact of refranchising more of its bottling operations. In the Philippines, in Bangladesh, in parts of India. Look closely at that list. The thing that dragged the reported number down was, in part, Coca-Cola pushing even more of the low-margin work out the door. It accepted a messier headline figure in exchange for owning less of the heavy business. On the cleaner, comparable measure the company prefers, the margin actually went up to about 30%. The direction of travel is unmistakable: less factory, more formula. Every year a little more of the syrup, a little less of the water. It is worth pausing on just how much of this rests on two things you cannot weigh on a truck: the formula and the name. The recipe is famously kept secret, and that secrecy is not a marketing gimmick, it is part of the asset. A bottler cannot simply make its own version. It has to buy the concentrate from Coca-Cola because only Coca-Cola Coca-Cola has the formula and the right to the name. That is the lever. The bottler can own all the plants and trucks it likes, but the one ingredient it cannot replace is the syrup, and the company that sells the syrup sets the terms. The brand and the formula are the choke point of the entire system, and Coca-Cola owns both. Everything heavy flows around them. The money flows through them. You can even see the two halves move at slightly different speeds. In 2024, the actual drinks reaching consumers, what the company calls unit case volume, grew about 1%, while concentrate sales grew about 2%. They are linked, but they are not the same number, because Coca-Cola gets paid on the syrup it ships to bottlers, not on the can you eventually buy. The company lives one layer back from the cooler. And that layer back is where the margin lives. So here's what Coca-Cola really is. Not the world's biggest soda bottler. It is the owner of a formula and a brand, selling a high-margin syrup to the companies that do the actual bottling. The drink in your hand is the bottler's product. The recipe and the name are Coca-Cola's business, and the concentrate is how it gets paid, at roughly 30 cents on the dollar, while the people making the real thing keep around 13. Once you can see that shape, you start spotting it across whole industries. The famous name on the product often is not the company sweating to make it. It owns the valuable, light part, the formula, the design, the trademark, and it farms out the heavy, low-margin part to someone else. The chip designer doesn't run the factory. The fashion house doesn't sew the shirt. The hotel brand doesn't own the building. The label is the asset. The factory belongs to a partner. The thing that looks like the whole business is often just the part you were meant to see. Next case, a swipe of a card that feels free to you, where the store you are buying from quietly pays a fee on every single purchase. That is how credit cards really make money, and it is not only the interest.